Hello, this is Chuck Carnevale, and the title of this article is Should You Care That the Market's Overvalued? And then the response was, it depends. But the real underlying theme is mind your own businesses. In other words, don't worry about the market, worry about the things you actually own. And then an additional secondary theme would be it's a market of stocks, not a stock market. Of course, the S&P 500 is one of the most commonly utilized index to illustrate whether the market in general is overvalued or not. And so let's look at the S&P 500 index from the perspective of earnings first, as you see on this fast graph. This is a plotting of the S&P 500's earnings per share from 1998. And what I want you to notice are a couple of things. There's actually been relatively steady growth in the S&P 500, and there were interruptions in both recessions. The recession of 2001 connotated here, and then, of course, the Great Recession, which was a little more severe in 2008 and 9. But the average earnings growth rate over this time frame was 5.8%, which is relatively normal for the S&P 500. Now, this is important because that number represents the average growth of U.S. companies in the S&P 500. Also, just like we see with individual stocks, the S&P 500 generates a dividend. And what you see here is a plotting of the S&P 500's dividend over the years. And I do want you to notice that the dividend was cut in the 2001 recession, and it was also cut in the 2008 and 9 recession. And you can see that by the curvature of the white line here, which plots dividends. Another interesting aspect of this chart is the dividend payout ratio, which is the area below this white line. This is the portion of S&P 500 earnings that have been paid out. And we also stack that on top of the orange earnings valuation line, which represents a PE ratio of 15, to illustrate the total return concept, which is capital appreciation, which is a function of price movement, plus dividend income. Next, I'm going to add monthly closing stock prices over this time frame. And this gives us a couple of perspectives. One is it gives us a perspective of valuation, the orange line being a theoretical valuation reference. And when the price is above that orange line, like it was in the irrational exuberant period back in 08 and 09, you saw, as you see here, PE ratios in the 25 to 28 range on the S&P 500. And then coming out of the recession, of course, created a big drop in the S&P over that time. But this was a clear picture of pretty significant overvaluation. Then we saw relatively normal valuations, more or less in line with the growth of the S&P's earnings. And then the Great Recession came along, and there was modest overvaluation at that point, technically, with the PE sitting around 17.5. But as earnings of the S&P fell, and as they cut their dividend, the price fell precipitously, and we all know, what that was like. We all went through it. But then as the recession ended, the S&P 500 began to grow again, or the U.S. economy and the U.S. stock market began to grow again. And coming out of the recession especially, I want you to notice you had a 39% growth rate of earnings in 2010, which is more of a reversion to the mean. And then the S&P 500, of course, has done extremely well since the Great Recession and now sits moderately overvalued with a blended PE ratio of approximately 19.7. Now, as I already suggested, an underlying theme is that it's a market of stocks, not a stock market. And the other is that, why should you really care that the S&P 500 is overvalued? But having said that, there is value in looking at the overall index, in my opinion, because it does give you a general sense of how stocks are valued generally. However, it is a market of stocks, and there are a lot of different kinds of companies that make up the S&P 500. Not all of them are overvalued. Some of them are great companies with great historical records, and some not so great. So let's take a deeper look into the types of companies that exist in the S&P 500. Let me start by taking a look at Alphabet Inc., better known as Google. And the first thing I want you to notice here is that A, Google doesn't pay any dividends. Second, earnings growth has been very consistent even through the Great Recession. It really wasn't around for the 2001 recession. We did see the price drop and the stock become pretty undervalued going into the recession. But I want you to notice the difference between Alphabet and the S&P 500. Here you have consistent earnings growth. In contrast, let's take a look at Ford, a very popular stock, well known, has a very high dividend yield right now of 5.2%. But what's really startling about Ford is when you look at it from a long-term operating history, you can see here that it's been very, very difficult for the automobile manufacturer here to make any money. You can see earnings growth has been very inconsistent over time, actually generated significant losses during the Great Recession, significant losses or losses during the 2001 recession, and relatively flat earnings growth since coming out of the recession, which is significantly different than what we actually saw with the index itself. So this does not look anything like what the S&P 500 did. This company has its own unique identity, characteristics, and metrics. In a similar fashion, let's look at Goodyear Tire, which is obviously in a related industry, but once again, you're going to see a company whose historical operating history doesn't even resemble the S&P 500. You also see periods of losses, you see dividend cuts, you see very erratic earnings results over time. Decent performance since we've come out of the recession, but obviously this company doesn't resemble what the S&P 500 itself actually looks like. Next, let's look at another example of a very non-typical, or, I'll call it not average company in the S&P 500, Micron Technology. You can see here that the earnings have been all over the place, the stock price has been all over the place, the company doesn't pay a dividend, and what you see here is another example of a stock that doesn't resemble what the S&P 500 index actually looks like. And then finally in this segment, let's look at another very cyclical, non-typical, what I would call not average company, Owens, Illinois. And you can see very clearly here that this doesn't, again, resemble the S&P. You see a very high correlation here between earnings and market price. But these last examples that I've shown here are clearly not what I would call long-term buy and hold blue chip stocks. They are components of the S&P 500, some of them more important than others, but the reality of it is that it is a market of stocks and not a stock market. There's a lot of differences between the individual companies that make up the S&P 500. Now let's move on now to a discussion of valuation. The market itself, as we saw in the original slide here, was overvalued. And here's CVS Health Corporation, and I want you to notice that it has a very consistent record of earnings growth, a little bit of weakness in the 01 recession, pretty good performance during the Great Recession. And when you look at its current market price, again, it's a healthcare stock, and there's a lot of controversy politically in healthcare now. We see that the stock is trading at one of the lowest valuations it historically has. But I also want you to notice that it has a very good dividend record and currently offers a 2.5% yield. This CVS looks entirely different than the previous examples we've covered so far. Tractor Supply Company would be another example of an undervalued stock in the market right now. And it's kind of interesting is, first of all, we see very consistent long-term earnings growth. We see this clear, obvious picture of overvaluation where price got completely disconnected from earnings. And now we've seen this significant correction, partially attributed to the low earnings growth rate that we're expecting for 2017. But even though the market's overvalued, Tractor Supply represents an example of a stock that's not overvalued. It's a market of stocks, not a stock market. Now let's move on to Lockheed Martin, because I think this has a very interesting story. Very similar to the overvaluation level of the market, Lockheed Martin is now overvalued. But this was a stock that became significantly undervalued for many years coming out of the Great Recession. Again, a lot of politics involved here. But the operating history was decent, flattened out a little coming out of the recession. Dividend growth was very steady over this period of time. Now this stock has gone from being significantly undervalued to currently overvalued. Mind your owned businesses. If you own the stock, worry about it. But don't worry about what the market's doing. Worry about the level of the individual stock that you actually own. There are also different kinds of stocks that make up the S&P 500, including real estate investment trusts. Perhaps one of the more popular is Realty Income. It has really a great record. You can see its operating history has been pretty consistent. Their dividend record has also been very good. They call this the monthly income company, but when you add monthly closing stock prices here relative to their normal historical valuations, I believe Realty Income is moderately overvalued in a very similar fashion to the market. And we see here in past times where levels of overvaluation created short-term underperformance. Great business, probably as overvalued as the general market is. So to summarize and conclude this presentation, the S&P 500 is clearly trading at a moderately high valuation level relative to historical norms. Here's the historical normal PE ratio. But keep in mind, this number is impacted by some of these high valuations here. If I shorten the time frames, you'll see that the historical normal PE ratio of the S&P since 2004 has been closer to 16 than 18, and the orange line here is a 15 PE. So this is definitely a level of high valuation, but as I showed in the video, there are stocks within this average, this index, that are overvalued. There are stocks that are undervalued. There are stocks that have very inconsistent operating history, stocks that have good operating history. Some pay dividends, some don't. It's a market of stocks, not a stock market. So I never really worry too much about what the overall market's doing, but I do focus very keenly on the individual holdings that I have. I believe it is a market of stocks, not a stock market, and I believe it makes sense to mind your own businesses. This has been Chuck Harneville saying thanks for listening.